All right, so chapter 12 and 13 we are doing together the Great Crash and the New Deal, and often I will refer to it as the Great Depression because it's all the same thing together. The Great Crash just kind of marks in history where we look at the beginning of the Great Depression, although it did actually start a couple years earlier with farmers. So we're back. We're still in the 1920s. It's the end of the 20s, 1928. We had said that Calvin Coolidge decided not to run for another term. So the Republicans nominated Herbert Hoover. Herbert Hoover had served in the cabinet for Coolidge, Harding, and had actually served in some positions for President Wilson during World War I. So he receives the Republican nomination, and there's Herbert Hoover. The Democrats nominated Alfred Smith. That's Mr. Smith. Hoover ends up winning the Electoral College 444 to 87. He wins the popular vote by about 6 million, which puts him right in that range of average. There's the Electoral College, the solid South there still voting Democrat, but everything else goes to Hoover. The big thing to look at when you're talking about the beginning of the Great Depression, everybody always looks at, is the stock market. Right? There's a picture of the floor of the stock market where trading is done. By the late 1920s, companies were overproducing. And because they're overproducing, they can't sell it, so they slow production. How do you do that? You start laying off workers and closing plants. The problem is when that happens, normally stock prices drop. In this case, though, in the 1920s, they continued to rise. Because everybody thought they'd get rich real quick on the stock market, they were also speculating, which means they were trying to get rich quick by investing in high-risk stocks. Right? However, they didn't always have the money, so they were doing a lot of this by buying on margin, which means, again, they're borrowing the money. March 4th, 1929, the Dow Jones was at 313. March 4th is important because that's the day that Herbert Hoover is inaugurated into office. A few months later, September 3rd, the Dow hits its pre-crash high, which was 381. The Dow Jones, remember, is an average of industrial stock prices. October 23rd, 1929, there is a change in the Dow. All of a sudden, during the last hour of trading, this is a Wednesday, the Dow drops 21 points. Right? That's a bad sign. Which leads you into the next day, which is Black Thursday. Right? October 24th, 1929, investors saw that 21-point drop. They get nervous. They start selling their stock. As people sell stock, that means more of it is available. When supply goes up, price goes down. Right? And so prices started dropping on the 24th. GE stock, General Electric, when it opened, it was trading at $400 a share. At the close of trading on the 24th, it was down to $283 a share. Losses for the day, $3 billion. Right? Now, those are called paper losses because if you had your stock at the beginning of the day, it was worth so much, but at the end of the day, it wasn't worth as much. So you didn't technically lose any money, but what you could sell it for was now less. That's called paper losses. Right? And there's the Pittsburgh Press for that day. So everything kind of stabilizes on Friday. The stock market closes for the weekend. Everything's okay on Monday. And then you get to Tuesday, October 29th. Right? That's Black Tuesday. The investors are in nervous type of state. They are just not sure what's going to happen, and they start selling their stock. And as stocks start getting sold and traded, prices drop, more people jump in, sell their stock, and by the end of the day, 16.4 million shares of stock were traded. That's a huge number of stocks. Losses for that day, $30 billion. And there you can see the stock market before and after the crash, what the value was, hitting its high point there in 1929, then dropping, and it will continue to drop until 1932.